says that it's going live. It says that we are now live. Welcome to the show, everyone. This is the show where we talk about all things like blockchain and tech and privacy. And today we're going to be focused on crypto taxes because recently, it was just over a week ago, the IRS came out with some new guidance. This is the first guidance that they have issued in the last 5 years. So the crypto community has been sort of waiting very anxiously about this guidance. And from my perspective, I don't think a lot of questions were sufficiently answered in it. But I have brought onto the show today, I'm absolutely delighted to have Sasha Hodder on the show. She is a crypto lawyer. She's also the host of the Hodlcast. Welcome to the show, Sasha.
Oh, thank you, Naomi. Always a pleasure talking with you about this kind of stuff. So thanks for having me on.
It's great to have you here. So let's go through the IRS guidance that was issued. Let's talk about some of the issues that you may have with the language that they use, because I know that a lot of people in crypto Twitter, for example, have been posting about the confusion that seems to be around some of the things that the IRS has said. By the way, welcome to the chat, everyone who is there chatting at the moment. I really appreciate you guys being here. And let's jump straight into it. So give me sort of a brief overview of what the IRS has come out with, and then we'll look specifically at some of the language used and why it may be problematic.
Sure. So the main thing, they put out two different things, and I think what most people read on Twitter was the guidance on the hard forks and the airdrops, but they also updated the FAQ section that was initially published with the 10/21/2014 notice. And in the FAQ section, they addressed some more questions that people had. So what they wrote about the hard forks and the airdrops was pretty bad.
Yeah, you're right. So do we want to talk about, let's look specifically about that aspect of the guidance. So they basically, it seemed to me that they've conflated the two. They've meshed them together as if that it was the same art apparatus that created hard forks and airdrops. Like, it was very confused from my perspective.
Mm-hmm. It made me question, like, maybe I just didn't understand how the hard forks actually worked, but I don't think there's ever a case where airdrops are given after a hard fork, is there? And that seems to be what they're basing it on, is if
it does not,
and an airdrop. So yeah.
Exactly. I think that's very confused. And so some of the people on Twitter have been talking about this as well. And I think that Marco Santori really got it right. So when he's saying, if there was a hard fork at all relevant to your crypto, then under what circumstances would you not receive crypto? Because that's basically what the IRS is saying. They were basically differentiating between a case where a hard fork happened and you were in control of the crypto that emerged from it, or you weren't in control. Now, he seems to think that the only scenario that this could clarify is perhaps if there was a hard fork and you had your crypto, let's say, in someone else's, like in an exchange, or someone holding the keys, in which case it sort of clarifies that if you don't have direct access to that crypto that was created from this hard fork, then you wouldn't be liable for tax. Now that kind of clarifies that one very narrow specific example. If you didn't have control over your private keys, it doesn't actually clarify what the liability is for the custodians of that. It doesn't talk about what the liabilities would be, like if they're holding the keys. Like, I mean, it's this very murky area.
Yeah, I read it. They would be responsible for those taxes if they didn't. So say Coinbase, like that's a big one. You know, they did distribute Bitcoin Cash, but as far as I know, that's the only forked coin that they did distribute, but they would have received a lot of other ones. So they probably have a giant tax liability as a result of this, because they would have been the ones in dominion and control of the keys when the forks happened. And how many forks were there on Bitcoin? Something like 75, or there were a lot. And I think the IRS didn't realize the volume of forks and the fact that some of these forks are no longer even relevant. They might not have an exchange where they're even able to be sold, but at the time of the fork, they might have had some kind of artificially pumped up price. So it really makes no sense to require people to pay tax on an asset I think CoinDesk, or I think it was CoinDesk that wrote, it's the same as someone burying gold in your backyard. You don't know it's there, and you still have to pay tax on that gold. Like that's about what they did with
Absolutely. Yeah, and so another thing that Marco brings up, and I want to go to some other people on Twitter and what they've said as well, like Jamison Lops talked about this as well, and they all brought up really great points. Like it's very clear that the people at the IRS just don't understand this nearly as well as the people in the crypto space. So Marco says, you know, in fact, the IRS says there's no taxable income so long as the forked coin is not airdropped or otherwise transferred to an account owned or controlled by the taxpayer. So he raises questions like, you know, why, and the question that you raised, Sasha, why would forked coins get airdropped post fork? In what scenario does that happen? If they were, who would do the airdropping? Why would they be airdropped into an account owned or controlled by the recipient? What would the airdrop have to do with the fork? I mean, these are all questions that make me think that the IRS wrote this using a bunch of buzzwords and didn't quite understand what exactly they were referring to.
Yeah, I think so too. And I think they've been asked a lot how to treat the airdrops. Probably every accountant that came across, you know, the situation might have, you know, individually or somehow tried to reach out for some kind of guidance on this. Because if someone is trying to do, you know, pay their taxes and handle this, then the accountant would have this as a valid question. I thought that they would treat it, you know, it makes sense. This is how they would treat other property. But like in, you know, on the grand scheme of things, if you get anything into your account, that would be income, and then, you know, that creates the cost basis for it for when you're going to go to buy or sell it. But the technology side of it really changes the dynamic of this, considering how many airdrops there are. They should have put a ruling in that if you get an airdrop and you then cash that airdrop, then this will apply. But if you just leave your airdrop and never touch it, you're never going to have a tax consequence.
But what does that even mean? Never touch it? Like, for example, if I have an Ethereum address and let's say my Ethereum is in cold storage and someone just airdrops a trillion really shitty coins, or maybe even some coins that have value, and I don't even know about it. I mean, are these coins, like the way the IRS has phrased this, it seems that we have to have taken active measures to take custody of these things. If I've just left this in cold storage and don't even know about it, have I effectively taken any action to be in custody of these things?
That's a good question, but I think the way I'm reading it, yes, because you have the capability of logging into that address. You're the only one with dominion and control over it. Even if you're not using it, they've created a tax liability for you.
Yeah, and so that's really problematic right there.
Step two is so many of the airdrops happened in 2017. So what, everyone's supposed to go back and amend their taxes? They should have made this, if they're going to make some kind of rule like this, it should be on a going forward basis, not something backwards, because people that did the airdrops or everyone receiving them maybe could have put some kind of notice or block on their account saying, like, maybe we need to have some kind of disclaimer saying do not airdrop. I don't know how that would work, but something that makes you not liable for someone else dropping, you know, random coins into your My Ether wallet or something.
Yeah. And I don't even know how that would work, because it seems like a giant loophole there. I could just put a do not airdrop into my account, and then, you know, if a bunch of people send me money anyway, because I don't know of a way that you can actually stop those things. If someone sends me money anyway, then, you know, have I just let go of all liability there? Like, well, I told them not to, therefore I don't have to pay taxes.
Yeah, well, there needs to be some way to, it's not there, but logically, like, it's just not fair that you should have some kind of giant tax liability because someone else decided to drop some random coin on you.
Absolutely. And let's read through what the document actually reads. So from the IRS, pertaining to what we're talking about specifically in this instance, they said if your cryptocurrency went through a hard fork, but you did not receive any new cryptocurrency, whether through an airdrop, a distribution of currency to multiple taxpayers, distributed ledger addresses, or some other kind of transfer, you don't have taxable income. And so that's kind of the problematic language we're talking about there. And then the point you brought up, Sasha, so this is something that Jerry Brito of Coin Center has responded to as well. And he said, you know, pointed out, one unfortunate consequence of this is that guidance of this guidance is that third parties can now create tax reporting obligations for you by simply forking a network whose coins you own or foisting on you an unwanted airdrop. And that's exactly what we're talking about. So does that mean that, you know, like, I mean, do we all just create a bunch of coins, put them on exchanges at a certain price and send it to a bunch of politicians who are creating these rulings, and then send them the private keys in an email and say, well, you have the private keys to these addresses and I sent you all this money. These are now obligations that you have. Like, is that what is needed in order to get the message through that this is not a realistic or feasible way to handle crypto taxes?
I never thought about that scenario. That might really get their attention. Find each of them, you know, that wrote the guidance. But
it's just crazy. So there are a few kind of examples of where this is problematic that Matt Corver has brought up. He's from Consensus. He says, okay, in one scenario, let's say we have, you know, Ether, he says, if Ether in cold storage and 500 people spam me with airdrops that I didn't want and can't dispose of because no one lists them. Because keep in mind, you can't, I mean, when you talk about cashing out, what does that even mean? That probably means transferring to another currency. But if one had value as already, like there's no, you don't even need to transfer it into another one if you're trying to figure out like how much you owe. Like, you know, if you owe taxes on it, it means that the initial airdrop was valuable, right? So can't dispose of because no one lists. And if no one's listing your coins, there's no liquidity there. So I need to take the Ether out of storage every year to send all 500 coins to an address that basically gets rid of them, puts them into the void in order to offset forcibly recognized income with loss. I mean, that's crazy. And another situation he brings up, he says, let's say Coinbase credits BSV to my account that I don't want, and they do it anyway. And let's say, he says, I do nothing with it. And then Coinbase and all US exchanges delist BSV. I still have taxable income on an asset I didn't want, didn't manipulate in any way, and can't dispose of. I mean, these are all scenarios that we're all dealing with. Like, how many of you out there had money in something like Coinbase? Suddenly your account is credited with BSV and then it gets delisted and you have no way of transferring it without illegally doing so by, you know, using a VPN and using something like Binance. But even then they delisted as well. So it's like a VPN and using some other exchange that isn't available to US customers. Like, there are all kinds of issues that are created from something like this.
Mm-hmm. It's and those are all real. Like the way that it's written, that's what we are expected to do based on this guidance.
Right. And so the other thing, Sasha, that I wanted to bring up, so you're talking about how they define having taken dominion over these coins or control. So let's say that Ether is in your cold wallet. And let's say you have the private keys to that, right? So you would say, well, you have control over that. But what if you don't have access to any software that enables you to have control? Let's say your ledger doesn't support that particular token or coin or fork, which is realistic. I mean, Ledger didn't support BSV. I don't know if they do at the moment, but they certainly didn't when the fork happened and a long time afterwards. So, you know, if you have money on there that you have access, you have control of the private keys, but you actually have no way of accessing your BSV, and even trying to split it yourself is problematic, and then only one part of the chain is transferred over. Like, all of these are big issues. I mean, I would presume that if you don't have software that is capable of handling these airdrops or forks, then, and you didn't actively try to download software or, you know, use a wallet that does support these things, then you don't have access to them.
Yeah, I think we'll have to see how those arguments get tested, but that makes sense to me. And I think it was CoinDesk also said, so when they wrote recommendations and sent those to the IRS, and they said the way that someone should exercise dominion over control is, or sorry, the way that it should be looked at is if you exercise that dominion. So if you do something to move those coins, then that's when you're kind of taking dominion of them. But if you leave them and don't touch them, then that should be looked at as not having dominion or control over them. But the way that it's written, I got to pull it up right in front of me here, how they describe dominion and control.
So they put it as, let's see here. Oh, I did have that. Yeah, I don't have that.
Okay, one thing that they said, a taxpayer does not have receipt of the cryptocurrency when the airdrop is recorded on the distributed ledger if the taxpayer is not able to exercise dominion and control over the cryptocurrency. So I guess, there can be lots of arguments on how to able to exercise dominion and control. Like if there's nowhere to sell the thing, then how can you exercise that? So.
Absolutely. And also surely the know how to do this would come into play, but I'm presuming that it's not going to. Like, what if you set up a Bitcoin wallet for your grandma? You were like, hey, grandma, I'm going to make you a Bitcoin user. And I mean, do you think that a grandmother is going to have like the ability to have dominion and control over these airdrop tokens or forks, or like they're not going to understand how any of this.
Diamond IRS, like this much at the hour it was airdropped. And that's another thing. They only say it's the day that it was airdropped. Well, we all know crypto fluctuates a lot in one day sometimes. So like, do you just choose the cheapest amount that day, or
and also it goes further than that. Usually when these hard forks happen, they're not available on exchanges for a long time after that. So how do you determine the value at the time? Do you determine it by the futures markets at that time? Do you like, how is the value determined by something that isn't even available on an exchange?
Mm-hmm.
So I feel like we've done this episode about crypto taxes, the guidance IRS has issued, and it seems like it's just created more questions than ever. Like one definitive thing that we can say, which is an unfortunate thing, but clarity that we do have, is that the IRS has specifically said it will not create an exemption for transactions below a certain threshold. So that's what people were hoping for, and that's what I think people need to lobby for, is that in order to use cryptocurrency as cryptocurrency, money that you're actually using for things, like the whole point of this, I mean, in my opinion, is to get away from this monetary system that is tracked and monitored and they have custody over. So if you want to spend your money, basically you have to get permission from these third parties. Now, I thought that we created crypto because we didn't want to have to get permission in order to use our money. But the IRS is saying that they're not creating a threshold or anything. So if you actually do want to use crypto as day-to-day transactions, then every one of those things is going to be a taxable event. And that's a huge reason why I think crypto purchases have just slowed down, because people don't want the burden of having to keep track of, okay, what time did I buy that coffee? Okay, what was the price check at the time that happened? All right, so what time did I purchase that exact, what time did I get that UTXO? Or, it's just an absolute nightmare to try and figure out the tax implications of these everyday purchases. And the IRS said that, no, we're not going to make it any easier for you.
Mm-hmm. It almost seems, like this is the way that they can, like when you said you want to, what we want cryptocurrency to be is an untracked way of, using money or like dealing in finances where it's not under complete observation. But with all the different legislation or, administrative guidance, things that are coming out, it seems like that's exactly what they want, is something where it's, everyone's KYC'd, it's on, a network, they can see exactly what everyone's doing with it at all times for, all amounts, and some of their holdings on that. So one of the things they said from the IRS guidance, a taxpayer does not have gross income under Section 61 as a result of a hard fork if the taxpayer of a cryptocurrency the taxpayer owns, if the taxpayer does not receive units of a new cryptocurrency. Well, if you hold Coinbase, if you hold all your Bitcoin on Coinbase or some other fairly well-regulated exchange, you only got one of these airdrops. So it's kind of encouraging people like, oh, if you use Coinbase, it's very easy to pay your taxes. But we also, have full KYC and communication between every bank that, every transfer. So it's like they're comfortable with that enough that that's what they would like to see the masses doing is something like that. And this really discourages holding your own private keys, because then you're at risk for a, big way to figure out airdrops. And then the other, maybe not so much talked about cost of this, not only the actual cost of the income, but you're going to have to, everyone's probably going to need to hire an accountant to figure this out. And that's not cheap either. So it creates another bigger burden there too, because if people are trying to comply with it, it's, you know, to figure out each of the different airdrops and when it happened. I mean, maybe software will come out that has it all figured out as well, but it's really not favorable to Bitcoin users, this recent guidance.
Yeah, absolutely is.
Again, like, you know, down to the enforcement side, you know, I could never recommend someone not to pay their taxes or anything, but on something like this, what is the practicality of them? You know, if it's hard enough for one person to figure out, and if it's on a wallet, like the ones that received airdrops, the most part are wallets that were not KYC'd. So, you know, how practical is it that the IRS will find it's just a risk versus reward thing here, I guess.
Well, I mean, one thing I would say about that is it gets into dangerous territory. So I'm all against the expropriation of wealth, and anyone who knows me knows that. But it's also very clear how traceable Bitcoin is. In fact, there was an article that came out, like Zero Hedge reported a couple of days ago, about this this entire site that was brought down basically because they tracked Bitcoin purchases, because it's very easy to track this stuff. Not enough people are using mixing solutions. Even then, they, you know, people make stupid privacy errors where after mixing, they put all their coins together, and or they link it to something that has already been KYC'd, and that enables people to go back and do the correct forensics on the blockchain to figure out where Bitcoin has come from, where it's going to. So, I mean, if you think that you're using this and you're private and no one's going to find you, I think you need to be smarter than that. There are privacy tools out there for helping you. I encourage everyone to be making the most of every possible privacy tool, not for evading taxes, not for any of that, but just because, you know, financial privacy is a right that we all have, and I think everyone should be exercising it. But it is, I mean, it's this very difficult scenario that's happening right now. Like you mentioned, Sasha, that, you know, if it, like, how hard is it for the IRS to prove all this stuff when the individual can't even prove it, you know? But the problem is the IRS has the power to send us these bills, and the burden is on us to prove that these are not correct. And what's happened so far is, I mean, I got a letter from the IRS as well. What happens is, if you had ever had your money on something like Coinbase and then you move it off, Coinbase doesn't have the information to know where you sent your money to. They don't know whether that was a purchase or a transaction or anything. All they know is that it was in an address that belonged to you, and now it is an address that is unknown. So what they have done is they've gone through and sent to the IRS all of their reporting and said, well, Naomi Brockwell had X amount on Coinbase and then she took it off. You know, therefore we estimate she owes this much in taxes. You get a letter from the IRS that says, we think you owe a huge amount of taxes. And now the burden is on you to prove that where you sent it was actually your own address and you didn't sell it or anything like that. So it's just, I mean, there's a huge burden on the individual. This is no coincidence. This is not the government just saying, oh, we accidentally put a bit of burden on you. We're really sorry. We still hope this whole crypto thing works out. No, this is an active pursuit of shutting down cryptocurrency, which very much threatens governments, which very much threatens the control over the monetary system, control over people's finances, etc. So, I mean, we've got to figure out what the next steps are here. You know, there's very little clarity, again, that's been given in this document. I don't think that the IRS really understands it at all. I think that they've gotten wording incorrectly. I think that the best step at the moment, and this is something that Snowden has brought up time and time again, a lot of people in the crypto space are bringing up how important it is to be lobbying your representatives about this and making sure that, you know, in your district you have favorable cryptocurrency regulations. Because this, I mean, whether you like it or not, you can go and live on an island, you can go live outside of the power of the state, you can try and be private knowing the incredibly all-powerful pervasive tools that the NSA uses and evidently shares with whatever department needs them. You know, this, it's impractical to think you can get away from this. And so, although I encourage everyone to try and be as private as possible, just because I believe in privacy very strongly, I also also think that you have to be doing the dirty work of reaching out to representatives as well, and be working on attacking this on both fronts, because we need to get to a place where cryptocurrency is an easy to use tool that people are using, because that's the only way that individuals are going to get back their control over their lives.
Mm-hmm.
So
yeah, you're right.
I mean, is there anything else in this document that you wanted to talk about, just to kind of go over? So what they released, they issued the IRS notice 2014-21, and they also put out this frequently asked questions document as well that kind of goes through a lot of this stuff. Anything else stand out to you as being like particularly problematic? I mean, my biggest takeaway is that it's incredibly unfair to force people to try to liquidate these assets that they had no control over receiving, that they may not even want to receive, just to pay, you know, taxes on income that they didn't ask for in the first place and had got no control over receiving.
And receive no benefit from the
Absolutely.
income.
Absolutely.
Yeah, it's I guess one other thing. So it was brought up on, I think it was I saw it in a response to someone's tweet anyway, the idea that when you get an inherited gift from, say, a relative or something like that, if you don't want it, you can disclaim it. So I wonder if there is a way to disclaim these and just say, no, I'm not touching it. I disclaim this gift. You probably to fill out the form when you do your taxes, have to write, you know, each coin that you would disclaim. But when you disclaim a gift like that, it would automatically go to your next in line, or I always forget how to say the word, escheats to the estate, or to the state. So you could basically say, here, government, you can keep my forked coins that I don't want, and I'm not keeping them, and I'm not paying tax on them. So I'm not an accountant, and I'm not even really a tax lawyer. I just, you know, follow the Bitcoin tax stuff. So I think with the state, you know, an accountant that deals with estates regularly would probably have some more insight on how that works. But that might be what we could do here, is just say, I disclaim any of these forks. And then the other thing that happened recently was that they put right on the 1040 form, they ask the question, now, do you own cryptocurrency? So I don't know if that's a good or bad thing. Like, a lot of people are saying it's terrible, but maybe it, you know, makes some people feel a bit of FOMO, like, oh, Jesus, so many people own cryptocurrency that it's right here on my 1040 form. What am I doing not owning any yet? Or it makes everyone that owns it like, oh, I don't want to own or have anything to do with this stupid stuff anymore, because it's just creating such a mess on my tax form.
Oh, absolutely. And taxes are a big enough mess as it is. The only other thing that I want to mention is this whole first in, first out accounting.
Yes.
So I think that's important. And I mean, this was something that I brought up in a video about a year ago, thinking about how Bitcoins are these unique assets. You know, they're not as fungible as people would like you to think. In fact, they're not fungible at all in a certain light, because the Department of Treasury is able to blacklist certain coins. Like, you know, the fact that UTXOs are these very unique, identifiable things means that you could blacklist people. You could differentiate between different Bitcoins. Like, let's say that you bought Bitcoin for 20 cents and then you bought another Bitcoin for $20,000, right? You know, and then let's say you sold $5 worth. Is that $5 that you have to pay capital gains on from the 20 cents one? Is that $5 that you probably get a loss on from the $20,000 one? And it's about figuring out, you know, how do you report that? Are all of these things meant to be fungible? Do you take the average in the account and figure that out? And so what they've said is, they basically clarified that you could either, you know, treat each asset as individual if you're able to track that, and you can figure out which UTXO you spent, or you could use the first in, first out accounting method. So explain to us what that means and how that might be favorable in certain circumstances.
Sure. Yeah. So that was something, it's been a question for quite some time, that now they finally addressed it. But I think people thought that you could do this all along, but now it's at least been clarified that yes, you can. But the first in, first out just means basically you can specifically identify it to make it a less tax burden for you. So if you are actively spending your Bitcoin, and say you bought a bunch of them a long time ago, but you've continued to buy and sell, more recently, you can match them up closer so that you're selling ones that are closer in price to when you purchase them, so your capital gain won't be as large on each one. So it's very, time consuming if you're doing a lot of those transactions to do that, but computer software can also do it for you. If you just put all your things, I think on bitcoin.tax, it used to have a way, then they took it off. And then probably now after this guidance, it'll come back on, where you can just you can look at it from each way and find out which is cheaper for you, and then choose that way.
And one thing that I would encourage everyone to do, I mean, so that you do have the ability to choose which UTXOs you want to be spending and all of that, like just use different, not even different addresses, because that's going to pull together UTXOs from different addresses if it's in the same wallet. I would say use a bunch of different wallets. Try to keep everything very separate so that you can differentiate between UTXOs and figure out which is in your best interests to report. And maybe some of those, have been linked to KYC at some stage. Keep that in mind when you're deciding what to do with it. Maybe some of your wallets have never been linked to KYC, and you bought a computer with cash and you used an IP address that you didn't log into any of your accounts with, and it isn't linked to your names at a cafe or something that has no cameras. Like, it's very difficult to have privacy in the Bitcoin space. It is possible, but just be aware that all of this is it's dangerous territory. The IRS is coming down serious on all of this. They are sending out letters to everyone they possibly can. You can bet that it's not going to stop with a letter. There's going to be a lot of follow-up there. So just make sure you're making the right decisions for you. A disclaimer, as I mentioned in the video description on this, none of this is tax advice. Sasha is a lawyer. She is a crypto lawyer. She is not your crypto lawyer. So if you want to be figuring this stuff out, get a crypto accountant who specializes in this, get a crypto lawyer who specializes in this, and get personal advice for you. But we're just here to kind of go through this craziness that was the IRS guidance that they released, which just, in my opinion, does not seem like guidance at all. Raises a lot more questions than I think it answered. But I mean, do you think it's going to be another 5 years before we get clarity on this guidance?
Oh, Naomi, I'm hoping they just issue a new thing and say, oops, we did that one wrong. Here's the new guidance, and give them what I think it should look like is airdrops and forks. If you don't touch them, you don't have any liability on them until you touch them. And then if you do use them and sell them, then what the guidance they gave makes sense, that it's income as of the day that you got it. And, that's fine. But they should also have on all international currencies that we would use. If I'm spending Canadian dollars in America, if I'm spending less than 800, I don't have to worry about taxes. And I think the same thing should apply to cryptocurrencies, so that we could at least do some level of purchasing and spending of Bitcoin without having to worry about the capital gains and losses. So.
Absolutely. Well, hopefully this has been helpful at all. I don't know if there's any final remarks that you would say about going forward before we wrap this up.
I think your point of reaching out to your local government is probably the best advice anyone can. That's the best step forward now, because we've got pretty bad tax guidance, and we need some kind of lobbying to get it made better, or to get it improved.
Right, absolutely. And you have people like, Caitlin Long's done an amazing job with this in Wyoming. She's really just spearheaded. I mean, she's someone who cares a lot about what goes on in Wyoming, because that's where she's from. And so she's taken out her time voluntarily to work on this and to petition politicians there and to get them to understand this. That was the biggest issue, is that the politicians there were about to pass some terrible laws regarding custodianship of cryptocurrency. And she went in, she educated them with her team of just taking her own time out to do this. And because of her, they passed some really favorable crypto regulation. The problem is that not every state in America has a Caitlin Long. And so I think that people need to be taking it upon themselves to be writing to their representatives, whatever state you're in, start to be proactive about this, because it starts with the states getting favorable jurisdictions, and then you can start to, move the federal laws. This is what's happening with marijuana, for example, where the states took the initiative. You had places like Colorado saying, hey, listen, we're just going to legalize this. And so from there, it started off this chain reaction of other states following suit. And now, really the ball is in the federal courts about what's going to happen here. There's a lot of pressure there. That's the direction we need to go in with cryptocurrency. We need people to be being proactive in this community. I'll put a list of things in the description that I think would be helpful for people to do in your states, to reach out to representative, etc. But I do think that individuals need to not look around to other people to take this. I think we all need to be proactive about what's going on in the state where we live.
Agree. Yeah.
Absolutely. Well, Sasha, I really, really appreciate you being here. As always, you're an absolute delight and a wealth of knowledge. So thank you for coming on. If you guys haven't checked out Sasha's podcast, then make sure that you do. She always interviews some really interesting guests on there and has just a great expansive knowledge about cryptocurrency. So thank you, Sasha, for being here. Thank you everyone who has been here in the chat chatting with us. I really appreciate you guys being here. See you, Sasha.
Bye. Thank you.
All right, see you, everyone. Da-da-da.